Welcome to the Pro Ticker Deep Dive. Every autumn, it's almost like clockwork, isn't it?
Yeah.
Budget deadlines approach, the pressure ramps up to find money, and, well, Rome's eyes turn to one very large, very tempting target.
The nation's banks.
Yeah.
Especially now, given how profitable they've become.
Exactly. So today, we're doing a deep dive into this recurring, high-stakes political drama around a potential new bank tax.
That's right. And our mission really is to unpack the data for you. We want to figure out, can Italy actually tax its way out of these fiscal gaps? I mean, that's the political aim.
Or is this just going to backfire again? Scare off investors, maybe tighten up credit, right when the economy could use some support.
Precisely. And you have to see the bigger picture here.
It's not just Italy feeling this pinch.
No, not at all. Governments across Europe are under pressure. They need to balance their books, meet these renewed EU fiscal rules.
And in that kind of environment, the financial sector, which has done very well from ECB rate hikes,
becomes a really convenient target. Politically convenient anyway. They call it a solidarity contribution.
nice term for it.
It's an easy story to sell, tax the rich banks. But the actual economic impact of doing that, well, that's always much more complicated and risky.
Okay, so let's dig into the numbers that are causing all this political heat.
Yeah.
Really need to grasp the sheer scale of the profit surge we've seen, say, between 2020 and 2024.
The figures are, well, pretty staggering, actually. If you look at the combined profits of the big Italian players, Unicredit, Intesa Sanpaolo, BPER,
The main ones, yeah.
they went from just about $2 billion combined back in 2020
Okay.
to over $25 billion by this year, 2024.
Wait, from 2 to 25 billion? That's more than 10 times.
It is. It's a massive leap.
That kind of jump must just paint a giant red target on their backs for any government looking for cash.
It absolutely does. And if you look Europe-wide, for context,
How do they compare?
well, total EU bank profits also surged from around $52 billion to $108 billion in that same time frame. A big jump, yes.
But not 10 times.
Exactly. Italian banks multiplied their earnings by over 10 times. They're sort of outliers in the Eurozone's recovery story, profit-wise.
And obviously those huge profits mean huge payouts to shareholders too, right?
Oh, definitely. Shareholder distributions like dividends and buybacks, they've jumped fivefold. We're talking about $23 billion returned to shareholders in 2024.
23 billion, up from what, about 4 billion back in 2020?
That's the scale of it. It's undeniably a boom time for them financially.
But is this boom built on shaky ground, or are they actually stronger?
No, fundamentally they are stronger. Italian banks are probably in better shape than they've been in decades. Balance sheets look healthier.
And the bad loans, the non-performing loans, the NPLs.
Significantly down, way down. And their key profit metric, return on equity or ROE.
Right, ROE. Let's just quickly remind people what that means.
Sure. It's basically how much profit a bank makes for every euro of shareholder capital invested. It's a measure of efficiency.
And for the top Italian banks.
It's trending above 15%, which is really quite strong.
15% ROE. So
Yeah.
very profitable, very efficient.
Largely driven, of course, by those higher European central bank interest rates we mentioned.
Okay, so you put it all together. Strong fundamentals, much lower risk than before, and these massive profits.
And that is exactly what makes them such an easy political mark when Rome feels the budget squeeze.
Right, but before we get into what they might do this year, we really need that context. Because this isn't a new idea, is it? They've tried this before elsewhere and, well, right here in Italy.
We're dealing with the ghosts of taxes past, you could say.
Let's start abroad. Spain tried something similar.
They did. They brought in a so-called temporary banking tax back in 2023, which, interestingly, has now been extended through 2027, so maybe not so temporary.
And how did that go? Did it work as planned?
The results were pretty mixed. The key thing is the actual money collected, the revenue, fell short of what they initially projected.
Okay, and who ended up paying?
That's the other point. It wasn't really spread evenly. The really big lenders, your CaixaBanks, your Santanders, they carried most of the weight.
While the smaller, maybe regional banks?
They largely managed to dodge the bullet, which kind of complicates that whole solidarity narrative they were pushing.
Right, but the real ghost haunting Rome, as you put it, is probably their own attempt last year in 2023.
Oh, absolutely. The Italian fiasco of 2023. You probably remember the market chaos when the government just suddenly announced this huge headline-grabbing 40% windfall tax.
I do remember that weekend vividly. It felt like watching a slow-motion train wreck for bank stocks. Investors just hammered the sell button.
Instantly. The market reaction was brutal and immediate. Billions wiped off bank valuations in like a day or two.
So much for grabbing headlines.
Exactly. That backlash from investors was so sharp, it basically forced the government to backtrack almost immediately. It really showed how, fragile market confidence can be.
And the final version, what did they end up with after all that?
The watered-down version was, well, almost symbolic. It was capped at just 0.1% of a bank's total assets.
0.1%. Did that even raise any money?
Practically nothing. It
Yeah.
generated almost zero actual proceeds.
So a huge political storm, massive market volatility for basically no fiscal gain. You'd think they'd learn from that.
Well, that 2023 mess was definitely a costly lesson. It showed very clearly that these quick fixes, often aimed at, let's say, populist sentiment,
Yeah.
can have really severe long-term costs in terms of market trust that just dwarfs any potential tax revenue.
So are they being more careful this time around?
They are more cautious. You can sense that. They certainly felt the market heat last year. But, looking at that $25 billion profit pool,
Right.
the temptation is obviously still very strong. Too strong to ignore completely, it seems.
Okay, so let's break down the choices they seem to be weighing up right now for this budget cycle.
Right.
Path number one seems to be the more aggressive one, right? The outright revenue grab?
Yeah, basically a Spanish-style tax, a direct levy on profits or maybe revenues.
And the estimates are that could bring in, what, about $2 billion a year?
Roughly that, yes. Which would trim the sector's overall profits by maybe 7%. Not insignificant, but maybe not catastrophic either on paper.
Okay, that's path one. What's the alternative? You mentioned a milder approach.
Right. The second path leans more towards what you might call fiscal pragmatism. It's less about a new tax and more about adjusting the timing of existing tax elements.
Timing? Like what?
Specifically, the idea revolves around delaying tax breaks linked to something called deferred tax assets, or DTAs.
DTAs, okay. Sounds technical. Can you unpack that quickly?
Sure. Think of DTAs as basically IOUs from the tax authority to the banks. They're future tax deductions the banks earned, often years ago when they were cleaning up bad loans or restructuring.
Ah, okay. So they can cash these in later to reduce their tax bill.
Exactly. So the government could say, okay, you can still use these DTAs, but just not yet. We're delaying when you can claim them.
Which gives Rome cash now.
An immediate cash boost, yes. But crucially, it's likely a one-off timing shift, not a permanent new tax that hits profits year after year.
So the opportunity, if they choose this milder path, this restraint, it's potentially quite significant.
It could be huge, yeah. Investors might reward that kind of predictability. You could see higher valuations for the banks, maybe tighter spreads on Italian government bonds because the perceived risk is lower.
It's signal stability, I suppose.
Right. And beyond the markets, avoiding a big, ugly fight over a bank tax right now probably boosts Italy's credibility with Brussels, too.
Which matters, especially with EU fiscal reviews coming up.
Yeah.
They want to look like reliable partners.
Political stability counts for a lot there, not just the numbers on the balance sheet.
Okay, now let's flip to the costs. The risks, if they do go for the more aggressive tax, that $2 billion cash grab. Risk number one has to be financial stability, right? If you tax banks more heavily, don't they just lend less? Could it lead to a credit crunch?
That's the primary concern, yes. A credit tightening. Especially for the smaller businesses, the SMEs that really rely on bank lending. It could undermine the very economic growth the government needs.
Even if it's only 7% of profits.
Well, it's not just the amount, it's the signal. Repeated political interventions, the perceived risk of doing business in Italy goes up. Banks might prioritize keeping shareholders happy with dividends.
And compensate by being much tougher on loan applications.
Potentially, yes, leading to credit rationing, which hurts the real economy.
Okay, and risk number two is just broader market confidence, repeating 2023.
Exactly. Another misstep, like last year, would seriously chill foreign investment. It raises the bank's cost of capital because investors demand a higher return for taking on that political risk.
And capital tends to flow where it's treated best.
It's very mobile, yes. Arbitrary-seeming taxes send a really negative signal.
Is there a European dimension here too? Does trouble in Italian banks spill over?
Oh, absolutely. What's really interesting, and maybe different from, say, the 2011 crisis, is how much more interconnected the European banking system is today.
So weakening Italy's major banks isn't just an Italian problem.
No. It could very quickly raise funding costs and put pressure on valuations across the board. That kind of stress wouldn't just stop at the Italian border. It could ripple through the wider Eurozone system. We're talking about the Eurozone's third largest economy after all. Systemic stability concerns definitely come into play.
Okay, so the stakes are clearly very high. You're balancing that immediate need for maybe $2 billion against these potentially much larger long-term risks to credit and confidence. Let's pivot now and see how investors are actually pricing this risk in the market. What are the technicals telling us?
Right, let's switch from the political chessboard to the trading screens. And actually, despite this tax talk, Italian bank stocks have been incredibly strong performers overall.
Really? Even with this hanging over them?
Yeah, the main index, the FTSE Italia All-Share Banks Index, is up something like 40% from the lows it hit during that 2023 tax fiasco, driven by those massive profits and shareholder returns we talked about.
40% is huge. But you'd expect that momentum to slow down now that the tax discussion is back on the table.
And it has. We are seeing some recent signs of profit-taking, maybe some nervousness creeping in. Stocks like Intesa Sanpaolo, BPR Banca, they seem to be hitting some resistance near their recent highs.
Anyone bucking the trend?
Well, what's quite notable is UniCredit. It's still acting as the sector's technical leader. It's holding its long-term uptrend much more robustly than some of the others.
Why would that be?
The market likely perceives UniCredit as being a bit more diversified internationally, perhaps slightly less exposed to purely domestic Italian political winds compared to some peers. That might be giving it some insulation.
Okay, so for listeners who are watching the charts, let's give them some specific levels. If this political noise gets louder, where might we see volatility kick in? Let's start with Intesa Sanpaolo, ISP.
Okay, for ISP, the key support level to watch is probably down near 5.0 per share. If the tax news ends up being mild, or if they go the DTA route, then you'd look for it to potentially challenge resistance up around 5.80.
Got it. And UniCredit, UCG, you said it's stronger?
Yeah, its key support is quite a bit lower, relatively speaking, down near 60 baht to euro. But if the sentiment turns positive, maybe they confirm the milder approach. UCG has serious breakout potential above 65. That would signal real investor relief.
Okay. Yeah, the other one we mentioned, BPER Banca.
BPER seems pretty range-bound for now, sort of stuck between 8.50s on the downside and 10.0 on the upside. A clean break below that 8.50 support level, though, that would likely signal that serious volatility is coming, probably driven by fears of a more aggressive tax hitting them harder.
So the technical picture really hinges on the political outcome here.
Completely. It all comes down to what Rome actually decides in the next few weeks. Which brings us to the key date everyone's watching.
The deadline.
Mid-October. That's when the government has to finalize its draft budgetary plan and send it to Brussels. That document is where we'll see the final official decision on the bank tax, if any.
And the market reaction will likely be instant once that's public.
Absolutely. Sentiment could shift very, very quickly around that mid-October deadline. Hashtag outro.
All right, so let's try and wrap this up. The core tension here is pretty clear. Italy's banks, after years of, well, struggles, are finally healthy again. They're profitable, they're well-capitalized.
But every single autumn, it seems, this political theater flares up, threatening to potentially derail some of that progress, all in the name of a quick budget fix.
Yeah. And that final provocative thought for you, the listener, is this. Raising $2 billion from a tax sounds like a straightforward win for the government, right?
On the surface, maybe.
But what if the real cost is erasing billions more in market value? What if it stifles lending to small businesses that need it? What if it damages investor confidence, not just in Italy, but across the Eurozone's third largest economy?
It's a serious calculation. Our bet. Rome will probably talk tough, make some noise, right up until that mid-October deadline.
But ultimately stop short of really aggressive action.
The odds probably favor that outcome, yeah. Recognizing the long-term risks likely outweigh the short-term cash. But the real lesson here, perhaps, is just how much political noise itself can move markets, even when the underlying fundamentals, those 25 billion profits, are actually quite strong.
A crucial reminder for investors everywhere. See you all in the next Pro Ticker Deep Dive.